Hello and welcome to the latest BCIS Outlook for Construction webinar. Before we start, some small items of housekeeping. As usual, this webinar has been recorded and will be shared with everyone who registered. It will also be accessible on our website, and if you want to stay up to date with the latest news and insights from BCIS, please follow our company page on LinkedIn. We welcome questions from attendees, and that's accessible using the little question mark icon on the page. We've already had some questions submitted prior to the webinar, which I'll answer at the end, and we'll follow up on any other questions that come through the Q&A box after the webinar's finished. Also, as usual, there'll be some poll questions that'll pop up on the screen during the webinar. They can also be accessed at any time via the little graph icon. The sort of purpose of these questions is for us to understand what you're seeing in your own role and your own part of the industry, and these help us to think about future content that might be useful for you. To allow the questions to be answered right up to the end of the webinar, we won't publish the answers during the session, but we will share the full results with you when we release the recording. Also, if any question isn't really relevant to you, just feel free to ignore it. Following the webinar, you'll also receive a short survey asking you for some feedback. Please take the time to complete the survey if you can. It sort of helps us to plan future webinars and content, and to understand how we can best help you going forward. Also, right at the end, there's also the option to ask any further questions that you didn't have a chance to ask during the webinar or that you think of later. So without further ado, let's get into the main body of the presentation. And what we're looking at today is what we think are the prospects for the construction sector for the remainder of this year and beyond through to 2029. To address that question, we'll examine the current outlook for construction, looking at sort of forecasts of future demand levels, the cost and price movement expected in construction. We'll then draw some conclusions and, as I say, address any questions at the end. So if we take a bit of time to set the scene, we've had 2 quarters of falling output, and that's wider economy output. GDP grew by 0.6% in the first quarter of 2024. This growth, however, was driven by the services and production sectors and not by construction, which contracted by almost 1%. So construction is in recession, and indeed the latest monthly output data highlights further declines in output. Continued high borrowing costs, a risk-averse market, and significant concerns around affordability have all impacted construction demand over the last couple of years. Add to this the lasting effects of recent global events, and also the largely unexpected announcement of a July general election, and the industry is left with a lingering air of uncertainty. So let's take a look at what might be next for construction. So first up, we'll examine the demand position for construction, and to do that we use a combination of BCIS and ONS data. It's important to note that the forecasts that follow are neutral to the results of the election. We've assumed that the result will not significantly affect current spending plans, as all parties appear committed to increasing the number of houses built and view investment in infrastructure as a lever for growth, although any new government will be constrained by the availability of funds. Private sector spending will depend on the performance of the wider economy, which we expect to be subdued. So whoever wins on the 4th is likely to be limited in terms of what they can deliver. Right, let's get started. If we now take a look at construction output. As you can see, it was another disappointing set of data for the construction sector in April, according to the ONS. with output across both new work and repair and maintenance sectors down on the previous month. ONS cited the effects of heavy rainfall and strong winds impacting construction activity in April. And indeed, the Met Office confirmed the month, which began with Storm Kathleen, was very unsettled and wet. And I think probably over the last few months, to be honest, ever since the end of last year, we've been struggling with rather inclement weather, which has no doubt had an impact on output levels. The largest falls in output were in housing, with both new work and repair and maintenance decreasing, suggesting that affordability issues are still having an impact across the residential sector. And if you look at the chart, I think it's fairly self-evident that while total output might currently be falling, we expect it to plateau this year. So from this period, mid-year onwards, we expect it to flatline, which is good news, I think, relatively speaking. Declines are evident in both new work and repair and maintenance output over the last year, but definitely we're looking at plateauing with some, or stagnation, should I say, with some recovery expected to start from 2025 onwards. So if we now take a look at the subsectors, we're concerned with new work output on this slide, and it looks as though we may have reached the bottom. So while 2024 is likely to see new work output plateau, we're expecting a subdued recovery in output from 2025, and that looks highly likely given the current conditions. And we're forecasting that growth will return to the two largest subsectors, and that's private housing and infrastructure. And our predictions are sort of dependent on the outcome of the election, but probably more importantly, the timing of expected interest rate cuts. We're optimistic that the new government will continue to see infrastructure investment as a key lever to economic growth, and infrastructure output is likely to be maintained at a relatively high level, with continuing work on mega projects such as HS2 and also Hinkley Point C, and along with offshore wind projects in the electricity subsector. Later in the forecast period, growth is expected as water companies mobilise their biggest ever capital investment programmes, and additional work to enhance the UK's electricity distribution network gathers pace. In addition, after some rather disappointing results over the last couple of years, we expect pent-up demand for housing is likely to translate into increased output in the residential sector over the next 5 years. Although it should be noted that private housing output is now at levels last seen in 2015, and is not expected to reach its 2022 level until the end of the forecast period in 2029. The next subsector to look at is commercial, which looks stubbornly flat, with only very marginal growth forecast through to 2029. Overall, total new work output is forecast to grow by about 20% over the next 5 years. If we now take a look at the repair and maintenance output, and as you can see, following sustained growth over the last few years, which peaked in the last quarter of this year, repair and maintenance output is forecast to plateau for the remainder of this year, following some recent declines. All sectors are predicted to stagnate over the next 12 months, largely due to ongoing affordability issues. But then we're expecting a muted recovery next year, largely driven by increases in private housing and non-housing repair and maintenance work. Another indicator of future demand is new orders. So if we have have a look at the new orders series. Total construction new orders increased by 16% in the first quarter of this year, and that's compared with the last quarter of last year. There was almost £10.5 billion worth of orders registered, and that's the highest level of orders since the first quarter of last year. Significant increases were seen in the private industrial and commercial sectors, although infrastructure and housing orders were down. And in contrast with the latest output data, which we've just looked at, which largely shows continued contraction and stagnation, new orders seem to have recovered, with robust growth evident in the first quarter of this year. So we're hoping that those orders translate into a much needed uptick in construction output going forward. If we now take a look at our short-term expectations, and the unfavourable investment climate, combined with the uncertainty that the election is bringing, continues to negatively impact output over the short term. New housing is still the main drag on sector activity, while repair and maintenance output in public non-housing is expected to pick up over the next 12 months. We're also expecting some limited growth likely in infrastructure output, which is the only real positive in the short term. We're expecting growth in the other subsectors to be largely flat through the remainder of this year. So we've looked at the demand position using construction output data and new orders, and it looks fairly positive. Obviously this year will still be a challenge, but certainly going forward from 2025 things look a lot more encouraging. Let's now take a look at the current inflationary drivers for construction using BCIS cost and price data. So on this chart we're looking at growth in the BCIS General Building Cost Index and Tender Price Index, and annual growth in tender prices as measured by the BCIS all-in TPI continues to ease, falling from 10.3% in the second quarter of 2022 to 2.3% in the second quarter of this year. So a significant fall. We expect inflation in tender prices to remain subdued through the remainder of this year, and indeed early next year, before recovering as demand increases. For the remainder of this year, BCIS expects annual growth in tender prices to continue to fall, reaching just over 2% in the fourth quarter of this year. It's not until the third quarter of next year that tender prices are likely to rise faster than costs, with tender prices forecast to rise by 18% over the next 5 years to the second quarter of 2029. If we switch to building costs as measured by the BCIS General Building Cost Index, they increased slightly by 0.7% in the second quarter of this year, resulting in annual growth of 3.4%. So significantly down on the peak. And similar to the last quarter, inflation continues to be driven by increasing labour costs rather than materials cost increases. Overall costs are predicted to rise by 15% over the forecast period, with labour costs remaining the main driver. If we now take a look at input cost inflation, on this chart we're looking at materials cost and labour cost inflation. Muted growth in materials cost inflation has continued into the first half of this year, and I think it's worth noting that following 2 quarters of decline, the BCIS materials cost index increased very slightly actually by 0.4% in the second quarter of this year, although this resulted in an annual fall of minus 1%. BCIS expects materials costs to begin increasing from mid-2024, peaking at around 2.3% in the first quarter of next year, before beginning a very slight upward trajectory through the rest of the forecast period, although nothing like we've seen in the recent past. However, it should be noted that the risks of this forecast remain on the upside due to increasing global uncertainty. Overall, we're forecasting material costs to grow by about 13% over the next 5 years. Taking into consideration, if we switch to labour, taking into consideration the wage agreements that are in place, the prevailing construction output forecast, and the general macroeconomic trends, we're forecasting annual growth in our labour cost index to peak at around 8%, and that peak is this quarter. So we believe that labour costs have peaked and are likely to decline thereafter to approximately 3% by 2026. And then we're forecasting the annual growth will return to the trend level of around 2.5% per annum for the last year of the forecast period. So overall, we're forecasting labour costs to grow by about 17% over the next 5 years. So a significant drop-off in both materials and labour costs inflation. Let's take a look at earnings. As we've seen on the previous slide, the growth in labour costs appears to be easing, but there is some conflicting evidence. If we look at the ONS average weekly earning index for construction, we can actually see that's fallen recently. And if we compare that to the annual growth in the all-in Hayes BCIS site wage cost index, there's certainly a disparity there. The Hayes BCIS data shows site rates rising by 7% in the first quarter of this year, and that's up from 3.3% at the last quarter of last year. And that is mainly attributed to, that growth is mainly attributed to an increase in rates for skill building and M&E trades. It's the difference between the series is probably the result of their coverage. The Hayes BCIS site wage cost indices are produced using market data from Hayes Recruitment, and that sort of generally represents short-term labour requirements for immediate fulfilment. And I think because of this, the index tends to be slightly more volatile and faster to react to changes in market conditions than the other labour indices. So if we now take a look at the market conditions, this slide shows the BCIS market conditions index, which is the relationship between costs and prices that we've looked at on the previous slides. So in the second quarter of this year, the BCIS market conditions index is forecast to decline by 0.4% compared to the previous quarter, which results in a fall of 1% overall when compared on an annual basis. And it's important to note that when the market conditions index is rising, prices are rising faster than costs, and when it's falling, costs are rising faster than prices. So we're still seeing costs marginally rise faster than prices. But looking ahead on our forecast, we can see stabilising materials prices and steadying site labour rates. We'll see the market conditions index rising towards the end of this year, and then tender prices are predicted to rise faster than costs over the rest of the forecast period, assuming that output levels are maintained. So that's a quick canter through our data-driven view of the outlook for construction, but there is only so much that data can tell you, especially when you consider the lag in producing that data. So we'll now examine some of the comments made by members of our industry panel at the latest meeting to try and get an understanding of conditions on the ground and what's actually happening on a sector basis. So the BCIS industry panel meets on a quarterly basis, and the last meeting was this month. So we've got some highlights from that, looking at capacity, procurement routes, sectors, and input costs specifically. In terms of capacity, it was noted that insolvencies are continuing to have an impact, particularly in some of the regions. The other note was attitude to risk is affecting prices in projects of different sizes. So there's currently caution within the supply chain regarding risk and exposure, which is leading to a reluctance to overstretch and take on risks that contractors may have historically done. So contractors are now much more inclined to bid for simpler projects, aiming to mitigate their cash flow exposure. Another point was that there's a general understanding that an improvement to the UK economy will encourage investment in the second half of this year, although it's worth noting that assumption is yet to filter through into actual work, and is therefore not yet being seen in tender pricing. The other issue that was flagged is that there's a question about how quickly the industry could ramp up to meet any increased demand, and again, I think some of this is going to be down to skills issues. Certainly, I think when demand levels pick up, there could be supply and capacity pinch points where there's inadequate labour demand, labour supply to meet the demand. But that's something we need to watch. And I think in the upcoming election, there's been some skills initiatives announced for construction. It'll be interesting to see how those translate into real life. So the next section mentioned by the panel members was about procurement, and they were seeing more competition in single stage procured schemes, where the supply chains have more dynamic pricing, and also working to reduce margins. The two-stage design and build projects tend to have a limited supply chain because they're normally larger, and that tends to insulate their prices from cost reductions. At the moment, the predominant procurement route for large projects is two-stage design and build, and the experience is that it's much more difficult to close out an acceptable contract price there than if the option is single-stage procurement, and that's likely to be having an inflationary impact on some of the larger projects. If we look at sectors, and there's still a marked difference between real estate, where actual building, constructing of buildings, and infrastructure delivery. Within real estate, housing continues to lag behind the other sectors. In the industrial sector, data centres are especially strong. I think they've taken over from warehousing. They also noted there's a shift in contractors' appetite to tender for new projects. So repair and maintenance work is remaining robust as a result, and this has been driven by government and housing associations investing in social housing refurbishment. And finally, on sectors that, as mentioned, data centres are looking to be a key draw for resources at the moment. So finally, from the panel, from our panel members, if we look at input costs, labour is still seeing some moderate amounts of inflationary pressure, although as our previous data forecast suggests, we think this is easing now. If we look at particular inputs, steel prices have fallen. This is likely because of lower energy prices, amongst other things. But note that copper price is increasing due to global supply and demand issues. And as picked up, I think, in the last couple of webinars, inflation in the mechanical and electrical market continues to run ahead of general building work. And this is largely due to supply chain pressures, so capacity issues, a shortage of skilled labour in that sector, and increasing prices for metals. One noted that the mechanical and electrical spike actually seems to be a new normal, and is unlikely to go down. Copper prices have gone up significantly recently, and that's due to speculation about hitting net zero targets, and the increased need for copper. Finally, it was noted that some mechanical and electrical plant components still have fairly long lead times, but for most other things, material availability is now back to normal, so back to pre-pandemic or pre-crisis levels. Okay, let's summarise what we've examined today in terms of the data from output and orders, the data from costs and prices, and also the anecdotal comments from our industry panel. So the data seems to suggest that the construction sector is still showing clear signs of recession as demand softens, and the effects of monetary tightening continue. And if you add into that mix that given the upcoming election, there's some uncertainty regarding future pipelines of work. There's doubts over private sector and institutional investors' appetite for investment in UK construction, which may delay projects until the new government outlines its plans. But having said that, the data that we've presented seems to suggest that there's some optimism around, and indeed this has been a relatively optimistic outlook for a change, and the metrics that we've looked at certainly look broadly positive, and I think we can summarise by saying that it looks as though the worst may be behind us. So, returning to our original question, what's next for construction? Well, what does the data tell us? While the period of hyperinflation appears to have passed, it's been replaced by falling demand as uncertainty rises and investment levels continue to fall. However, the fall in demand has released resources, and capacity issues are therefore less of a problem for the moment. But it is worth noting that this could change if demand levels pick up significantly. So if demand, as we're forecasting, recovers, there could end up being a blocker in terms of supply capacity, certainly in numbers of firms and numbers of workers available to deliver that increase in demand. So that's definitely something worth watching. In terms of output, the declines seem to have stabilised, and orders appear to be picking up. Tender price and building cost increases are relatively benign. Materials costs are stable following some declines, and labour cost increases appear to have peaked. So although we're predicting that 2024 will remain challenging for the construction sector, we expect a muted recovery in 2025 before some more robust growth returns from 2026 onwards. Okay, let's make a start on the Q&A. As mentioned up front in the housekeeping section, we've had some questions submitted prior to the webinar, which I'll answer now. And we'll follow up on any other questions that come through the Q&A box after the webinar is finished in the usual way. Not surprisingly, all the questions submitted so far are election-based, and I have to say, personally, I was very surprised by the election announcement and suspected that the incumbent would delay the vote for as long as possible, but perhaps they know something that we don't. So first up, the question is, will the election have an impact on demand levels? Certainly the uncertainty caused by the election is likely to have a negative impact on levels of construction demand, and certainly in the short term, as private investors adopt a wait-and-see attitude. In addition, government spending plans are likely to be stalled during PERDA, and the other thing to consider is that any new administration will obviously take time to get their plans and policies in place, so the knock-on effect will likely last months rather than weeks. And finally on that, I think whichever party emerges as victorious at the ballot box on the 4th of July will face significant economic challenges as they form the new government. Working out how to effectively support growth in construction will be among them, and this will involve big decisions on everything from net zero targets and a housing strategy to public spending and the management of major infrastructure projects. So I suspect there'll be a period of 2 or 3 months before things get back to something like normality, but we aren't predicting that will have a major impact on demand levels in the longer term, but certainly in the shorter term there could be some contraction. The next question is, main party manifestos have some similarities and also some differences. Public spending is going to be restricted for anyone coming in. What do you think the best thing the next government could do is to stimulate? What do you think the best thing the next government could do to stimulate growth, and what would be the worst thing they could do for the sector? Well, the worst thing would be to do nothing and carry on regardless, I think. Certainly it feels like over the last few years actually, the construction sector has been a sort of forgotten sector in the wider economy. Obviously the cost of finance is a major blocker currently, but since governments no longer have control over interest rate setting, that's no longer an option anymore. So governments can no longer control base rate setting, and I'm sure they wish they could actually now. Construction demand is essentially driven by investment in fixed assets. So any incoming government needs to set up a climate that encourages investment. Institutional investors need stability, and that's something that we haven't really had since the turn of the decade, probably globally, but particularly in this country. There have been a catalogue of missteps by the incumbent government that have made investors wary. If you think of Liz Truss and the fact that we've had 5 different prime ministers over the last 14 years, you add into that Brexit, and you can see why there's been some stability lacking in our economy. Essentially, the UK needs to be seen as an attractive destination for investment, and that means guaranteeing a return for investors. Given that public funds will be scarce for the next few years, any new government could look at new ways of attracting private finance to deliver construction projects. It comes with a fairly large caveat that we need to heed the lessons of past PFI schemes and restrict that initiative to building, so construction of assets rather than service delivery, which seemed to characterise the previous PFI incarnation. Another question: are there any policy announcements that stand out for construction? Aside from the two main parties' commitments to support house building and infrastructure, I personally think that the Labour Party's initiative to set up a new body to break the inertia, as they call it, of UK infrastructure delivery is a really positive move. The proposed body, which will be called, this will naturally trip off the tongue, will be called the National Infrastructure and Service Transformation Authority, or the acronym is NISTA. This would stipulate from the outset how projects are planned, designed and costed. The details are currently a bit sketchy, but it's proposed that the NISTA would involve merging the current Infrastructure Projects Authority, the IPA, and the National Infrastructure Commission, the NIC, into a single entity, and then from that developing public sector in-house expertise to better manage the delivery of major infrastructure projects. And I do think that that's something that's been lacking over the last decade or so, and bolstering public sector in-house expertise on major schemes where the government is an investor and needs to deliver value for public money, is a really good step forward. Okay, as said, if there's any more questions, we will address those after the webinar. But largely that ends today's webinar. Again, many thanks for joining. As last time, certainly from where I'm sitting anyway, a more positive and optimistic outlook for construction compared to the recent past. And I think it's going to be an interesting few months as we see the new government's plans outlined, and to see how they directly impact our sector. So hopefully see you next time, but that ends the webinar for today.